is an important factor, then I should be able to show that all the experts can make more money than the monkeys, right? That because they're monkeys, they're just throwing darts at the wall. Why in the hell would a monkey throwing a dart at a wall be able to make as much money as someone who went to Harvard who's got an MBA? That's crazy, right? And what he was testing was this theory in finance called the random walk hypothesis, which I'm not going to go into that today because we don't have enough time. But it's one of the most beautiful, most elegant theories in the history of all of finance. I think they won a Nobel Prize on this. So basically, what they did with the experiment was they took this basket of stocks that was picked by the monkeys throwing darts at the wall, and they compared the amount of money being made by the monkeys to the smartest, most experienced, most established experts on Wall Street. And do you know what happened in that experiment? And they replicated the experiment. That's one rule of the scientific method. You have to be able to replicate the experiment. When they replicated the experiment, the monkeys won about half the time. The monkeys won half the time, and people were shocked. People were like, "How in the hell can a monkey outpick an expert when it comes to stocks?" And what this says, and the reason that I share this with you is that the strength that the monkeys had is the monkeys didn't overthink it. The monkeys didn't let their fear or anxiety stop them from doing what they had to do. They said the monkeys like, look, I gotta throw this dart for this man, and then he gonna give me a banana. That's all. That's what the monkeys are thinking about. They're not thinking, gosh, I didn't go to college. I don't know if I can invest, or do I really have enough money? I don't know if this is good. Investing's for white people. Like the monkeys didn't do that. The monkeys were like, okay, just all right. So you're telling me if I throw this dart, I'm gonna get this banana? All right, great. And that's what they did. And so they picked these stocks. They didn't overthink it. They threw the basket of stocks together, and the monkeys made more money than the experts half the time. And I won't go into why this theory works. It's crazy. It has to do with how information is compiled into stock prices, and it's beautiful. It's mathematical. It's amazing. But what I want you to ask yourself every time you get nervous about investing, or every time you have a relative that tells you that investing is hard or complicated, just ask yourself, am I smarter than a monkey? And every single one of you, the answer is going to be yes. So what I'm saying to you is don't overthink it. Basic stuff, consistent habit, extremely important. It provides financial security, gives you a tremendous economic opportunity, and it doesn't require you to have a whole lot of education and skill. All this nonsense that you have to go to college and take a bunch of finance classes and go $200,000 in debt at a university in order to know how to invest is not true. I know people that have PhDs that don't invest very well because it's all about having the habits to really follow through on what it is that you know you need to do. So let's keep going here. So look, so when you talk about buying stock, let's talk about stock prices. There's what they call the bid price and the ask price. Okay, so I want you to know a little. I'm gonna tell you quickly. This is very very quick. We're gonna talk about what they call the bid ask spread. The bid ask spread basically is a reflection of two different prices that you're gonna have for every stock. The bid is what the buyers of your stock are willing to pay, and that means like so if you're selling, you're gonna sell at the bid price. So when I say what the buyers are willing to pay, that means the market maker who sits in the middle between the buyers and the sellers, they're going to offer you the bid price. So a lot of times with a stock, you'll see two prices. You'll see the bid, which might be 41, and then you'll see the ask, which might be 42. Okay. So you're thinking, okay, if so here's the simple rule. If you are selling your stock, you're going to sell at the bid price. You sell at the lower price. If you're buying stock, you're going to buy at the asking price. So just remember, when you're buying, you're going to pay a little bit more than you get if you're selling. And that difference is what they call the bid ask spread. That's how the market makers make their money because they have a buyer over here and a seller over here. The buyer and the seller will never meet each other. So what they do is they go to the seller and they say, okay, I'll buy your stock from you for $41. And then they go to the buyer and they say, oh, you want to buy this stock? This stock is going to cost $42. So just like any business, when you buy low, sell high, that's what they're doing. They have a business. They say, okay, I'm gonna buy it for this price, and then I'm gonna sell it for that price, and I get to make the difference. This is how most businesses are run. This is how banks operate. Banks will pay the depositor, say 4%, and then go over and charge the borrower 8%. So they make money from that spread. Do you understand? So that bid ask spread exists in the market. When the spread gets narrow, that indicates a lot of liquidity. And the part of the reason I don't like you messing around with these crappy stocks that are not traded very often is because what happens is that the spread gets really big, and then when you finally get to the point where you think you've cashed in, you made all this money, that spread eats into your profits so badly that you lose a lot of what you have. This has happened a lot to a lot of people that would buy these like obscure cryptos, and they might buy it for 25 cents, and then the price goes up to $25 or something, and then they go try to sell it and they can't sell it, or the spread is so big that the $25 becomes $10 or whatever. So ultimately, that spread indicates liquidity. Wide spreads indicate lower liquidity, and so that's just kind of a little tidbit. So when you go in there and you see two prices, just remember you're gonna pay the asking price, but you're going to receive the bid price. The bid price is what they're bidding for your stock. The ask price is what they're asking you to pay. Okay. Now, give me a yes if you follow this. Give me a quick yes. I'm going to take this slide down for a minute so I can just take a moment for a quick breather. Let me know if you guys are following this. Give me a quick yes if we're together on the same page. Also, if you have a question, you can put your question in the Q&A section. I only ask that you keep it, keep the questions like kind of tight so I can make sure I can answer as many as possible. And what I'll do, in fact, is I'll answer them really quickly. Greg says, should I complete the entire Prime course before I invest? I don't suggest that, just because what we tend to do is in the Black Business School, I'd rather err on the side of giving you too much information than to give you too little. So we kind of give you tons and tons and tons and tons of lessons and materials. And so the goal is not for you to try to consume everything that I want to teach you, because I want to teach you everything. I want to make sure everything's available to you. But I think that can be overwhelming. What I want you to do is have a choice. Okay, either I can just learn the basics and get started with the basics, or I can keep going, and there's an endless river of powerful, amazing stuff. Like, we record every single training we do. I teach every single day. I've been doing this for many, many years, and we save everything, because I know that there are trainings I probably did in 2016 that would be incredibly impactful for a lot of you for whatever it is you're trying to do in 2024. So no, do not try to go through the whole Prime program. The URL is drboyceprime.com if anybody wants to take a look. And that's kind of what I would say. That's my suggestion on that. How do you get a copy of the recording? Okay, Derek. So two ways. One is if you signed up for the class directly, then you can get the recording through wherever you signed up. If you are in the Black Stock Market program or in the Prime program, the recording will be put in both places, so you can get the recording there and watch it over and over and over again if you'd like. It's going to be in there for you guys, for sure. Derek, let's see. I'm a Prime member. Is there a place in the membership I can find the recording? Yeah, okay, so there we go. There's the answer to the question. And if you have trouble finding anything, I want to remind everybody that we have a great customer support team. If you email support@theblackbusinessschool.com, then you can actually get access to our support team. So email support@theblackbusinessschool.com. I wasn't able to start at noon. Okay, you already asked about the recording. Okay, great. So the recording is available. Can I share this info with your family? James is asking. Yeah, absolutely. Not only can you, but I ask you to, because I think that the same way negative culture can be contagious. I want positive culture to be contagious. So I want you to to take the lead and go to your family and just say, look, I know you all want money, and I know how you're getting money. There are easier ways to make this happen. Let's talk as a family so we can share and love each other. So same way we get together on for Sunday dinner and we feed each other, we should also feed each other knowledge, opportunity, and economic security, right? So that to me is an amazing gift. So absolutely, yeah, bring your family. We're very family oriented in the Black Business School. All right, so let's keep going. So remember this. Here's what I want you to also remember when it comes to ordering your stock, is that your order is not executed until you get a confirmation. You have to get a confirmation before the order goes through. Just because you place the order does not mean that you own the stock. So when you place the order to buy or sell, the order is sent to the market or to the broker. And then what they do is they take your order and they match it up. They say, okay, because what you basically done when you place the order, and I'm gonna show you guys this. We're gonna go to E-Trade, and I'm gonna show you an example on Robinhood, is that you're basically coming in and you are saying, I'm willing to sell this stock at this price, or I'm willing to buy this stock at this price, whichever one you're trying to do. And what they do is they say, "Oh, hey," they go over to the other side to everyone else, and they say, "Hey, everybody, uh, you know, Kathleen says that she wants to sell her IBM stock for $80 a share. Are there any takers?" Now, if Kathleen's offer is bad, like let's say the price is 100 or sorry, let's say the price is $40. Let me just do it, and she wants to sell it for 80. Well, then no one's going to take that offer. They're going to say, "No, we're not going to pay $80 for that stock. It's not worth $80." But Kathleen might be placing the order just in case the price goes up. She might say, look, just put it in the book. And if somebody comes along, if the price goes up, and it goes past 80, then I'll be one of the first ones to sell. But if it's not in that range yet, then no one will buy it. So she will not get a confirmation on that order. So this is why it's really important to pay attention to what the bid price and the ask price is. The bid price is the highest price pretty much that they're willing to pay for your stock. So if I have a stock and the bid price that they're willing to bid for the stock is $80, then maybe I put in a price that says I'm willing to sell for 79. Now it doesn't mean I'm really going to sell at 79. They're going to give me the best price available. They're legally obligated to do that, but it just kind of puts me at the front of the line. Whereas if I come in and say, well, I'm willing to sell at 90, then my order will not get a confirmation because the price is not 90. There are other people that are willing to take that stock at a different price. So they match your offer, and then you get a confirmation receipt, which you see inside the app, and then you can review the confirmation to make sure all your details are right. Make sure you got the stock that you're looking for. Okay, I wanted to buy 10 shares of Meta at this price. Okay, here's the price I paid. Here's how much money they took out of my account. This is what I now own. Just sort of checking that is really important. All right. So here's a quick overview of different kinds of stock market orders. So you can do a market buy or sell at the prevailing market price. So what that says when you make a market order is you're basically saying whatever the market price is, that's what I'll pay. Just put the order in, and it looks like the bid is here at 80, the ask is 81. Whatever the market price is, I'll take the order. Now, the reason that is, and that's fine. I do most of my orders are market orders, but the risk of a market order is that the price can change very quickly. If you watch stock prices on your phone, you'll see that the price of a stock can go up and down, up and down, up and down. So basically, if I place an order and I say just sell it to me at the market price or whatever, and let's say that in the next few minutes the price jumps by 2 or 3%, then I may pay more than I thought I was going to pay. Okay, so another type of order you can place to prevent the market order dilemma is what they call a limit order. And that's where you're willing to buy a security at or below a certain price or sell at or above a specific price. So if I do a limit buy order, then what I might say is, look, I'll buy this stock as long as it's not more than $100. If it's more than $100, I'm not buying it. Right. So we're putting a limit on that. So if the price jumps and goes to 102, then my order will not get an execution. I will not get an execution confirmation on that order. Same thing is true when it comes to selling. I might say, look, I'm willing to sell my stock at $50 or above. If it's below 50, I'm not selling. Right. So same thing is true in that case. Also, stop loss orders are used to protect against losses. So, stop loss orders, there was a training I did with you guys called Stormproof Investing, which was basically a series of techniques you can use to protect yourself for what I believe is the coming market downturn. The market is going to go down, it is going to cool off. Even stocks like Nvidia have been getting kind of ripped lately. I don't know how they're doing today, but Nvidia had a major drop, and because that's just what tends to happen. What goes up does come down sometimes. So anyway, if you want to take a look at that training, feel free to go to stormproofinvesting.com. Stormproofinvesting.com. Well, stop loss orders are one way to stormproof your portfolio. So what you can do, let's say that you're busy and you don't really want to sit and look at your stocks all day, but you know the prices are constantly moving and you're looking for an opportunity to buy or sell at a certain price. Well, you can put in a stop loss order that will activate a sell of your stock if the price drops below a certain point. So let's say you have a stock that you bought at 50, the price goes up to 80, and you want to protect your losses. So you say, look, if this thing drops below 70, then sell it. Then you can put in a stop loss order, so the order will automatically activate in the event that you are not watching your portfolio at that time. Okay, so let's look at, excuse me, what I call the Dr. Boyce method for stocks. I'm gonna go through a quick overview of it. I can't do the whole process because I did a whole stock market weekend where we did all this. But since we only have an hour and a half today, I'm going to go ahead and kind of give you the big picture of it. So it's created for beginners, designed to be very simplistic, and you can modify this to your own style. Okay, so this is not the be all end all or the gospel, but this is a way to approach things. So number one is if you want to get better at investing, do research regularly. Look at the types of stocks that are out there, common stock, preferred stock, stuff like that. You have a lot of different options. Study market trends. Maybe pay attention to, maybe find a couple of podcasts that you like where you can listen to them talk about things like consumer sentiment or the inflation data or the GDP numbers and just kind of listen to how they talk about it. It'll seem a little confusing at first, but eventually you'll get more comfortable with it. And then every now and then you'll hear something that you can invest with. I believe in reading the financial news regularly. That's what I do every morning when I get up. Every morning I get up, I put on my MetaQuest headset, which is the coolest thing ever, and I play Metaverse Golf, and with this app called Golf Plus. And maybe one day I'm gonna figure out how to do a golf tournament or something. I'll invite you guys in if you're into that kind of thing. And it's the most fun thing ever. It's like it's so realistic, and it got me into golf again. But while I'm playing golf, I'll be listening on my headphones to the financial news, so I can compete in golf tournaments online with thousands of other people. And I'm terrible. I usually get like 400th place or something, but I'm getting better. And also I am catching myself up on all the financial information. I've sort of tried to make that part of my subconscious process, my habit, my day to day. Right. So also you can choose a broker. There are a lot of good brokers out there. What I'll do is I'll give you some recommendations on brokers that I like. I believe online brokers are the best. If you want to, you can compare fees and the services. You can look at margin. Margin is a type of debt that you can be offered that is actually quite good in terms of giving you an opportunity to really expand your asset holdings. Debt is not bad. Debt is not good. Debt is just strength. It's power. It's economic power. It gives you the ability to own more assets, but you have to be really careful with debt, because debt, if it goes bad, can be very harmful. So you have to make a personal decision there. I believe in choosing more than one broker. One aspect of diversification that is not often discussed is diversifying between different apps or different brokers that control your money. Usain Bolt, he had all of his money with one broker, one investment advisor, and that investment advisor unfortunately kind of screwed him over, and the poor guy lost $12 million. So my belief is that you want to put your money in different places. I have about four different brokerages that I work with because I want my money spread out. I don't want all my money in one place. Also, you can choose a broker that fits your style of investing. So a lot of brokers also provide educational resources. Some of them have better customer service than others, like Charles Schwab, E-Trade have great customer service. Fidelity is good. I don't use it, but I've heard great things about Fidelity. Robinhood is built on simplicity. They don't have as good customer service, but they have a lot of good products in Robinhood, and it's really been fun for generating income from stock options. So if you are in the Prime program at drboyceprime.com, you'll notice that in drboyceprime.com, what we do is we generate our income from our stock options, and I typically do examples using Robinhood because Robinhood provides good margin, a simple process, and just an easy way to kind of understand sort of how that works. So again, if you want to go to drboyceprime.com and take a look, feel free to do that. All right. So next